morning, Matthew. I'm Frank Getman. I'm the CEO of Great Bay Renewables. Great Bay is the leading renewable royalty company in the world right now, and we have a great head start. We are the operating company owned 50% by Altius Renewable Royalties, listed on the Toronto Stock Exchange, and the other 50% is owned by Apollo Infrastructure.
Great stuff. Frank, thanks for coming on the show. Obviously, we know the Altius guys. He's been on the show a few times, and Apollo, I guess, needs no introduction. Can you just tell us about what that agreement looks like? You know, who needs to do what, who puts in what money, etc.
Sure. So, like I said, Great Bay, based here in the U.S., is the operating company. We are the one who goes out and sources deals and identifies deals and closes those deals. And then we are owned 50% by Apollo and 50% by Altius Renewable Royalties. It's a true 50-50 joint venture. There's no special rights or privileges. And so when we identify an opportunity, we bring it to our investors, and they fund it on a 50-50 basis. If there's ever a dispute or one party wants to go forward and the other one doesn't, there's a mechanism built in where we can still pursue the opportunity with one party, should that be the case. But to date, everything's been funded on a full 50-50 basis.
Right, and obviously those guys both have large pockets, which is great. Typical deal size is what? Just remind me.
I would say $20 to $50 million is a typical deal size.
Okay, that's nice. So if one of them doesn't want to go ahead with something, you can bring another party in. Would that change the equity dynamics, or would that be done at an asset level?
It would be done at the asset level, and we would still manage it. But the other party would get a carried interest on it, almost like a management fee, as though Great Bay was a fund. So there's still an economic interest for the party that doesn't participate, and that's how we made it fair for everybody.
Okay, and so I just want to understand roles here, because obviously, Altius, Apollo, money. You are the ideas guys. You're the ones that find the projects, negotiate the projects, and bring that to the table. So is all the diligence in-house at Great Bay?
Yeah, this is an important point. I have over 25 years. Our team has, each of us, we've been together for years, and we were developers before we started this renewable royalty business. We were renewable energy project developers. I mean, greenfield, dirt on our fingernails, out there getting the land, identifying the opportunities. So we understand the development process very well, which I think gives us a real leg up when we look at these opportunities. We can identify who are the good teams, who are the good projects, and it's not something that I think necessarily like a pure financial Wall Street investor would be able to really fully evaluate. So I think it's a real advantage for us. And I will tell you, when we walk in and talk to these renewable developers, we can understand their business. We can talk the talk, and they aren't concerned that we're trying to bring some fancy new Wall Street financing product that isn't going to work out for them.
I'm glad to see there's no kind of structured finance from clever Wall Street individuals making money for you-know-who. So back to the diligence component. You have been developers at the beginning, so you can talk their language, which is great. But what are you looking for? Because there's a big buzz phrase going around at the moment, which is basically energy return on capital invested, right? That's the phrase people are looking to. What are you looking for?
Right. We have a little different approach, is that we look for good teams. And we found that the teams who have a great track record, there's a reason that people are in the development world. It's a little bit like making sausage. Things don't go in a straight line, and sometimes it's a little scary, but good teams are able to get enough projects across the line that you can earn a good return. So we look for those teams that are serially successful, and we look to provide them with flexible capital that they haven't had access to in the past, to really accelerate their business and allow them to keep more of what they create, which is the compelling reason for them to work with us. So versus us going in, we are able to underwrite and look at their pipeline of projects and understand whether we think it's a quality pipeline. But by and large, we're looking for successful teams, because that's proven to be the biggest key indicators to future success.
Okay, so in terms of the word renewable, you're agnostic as such. I guess people would look to hydro, wind, and solar. Is that predominantly it, or is there other things?
We're doing utility scale wind, utility scale solar, associated battery storage. Usually it's with solar projects. We haven't done any standalone storage yet, though I expect we will at some point. The way to think about this is our capital is for the deployment of true and trusted technology. We're not a VC firm out, seeking to determine which is going to be the next winning, hydrogen technology. But even hydrogen, at some point, when it becomes proven, and they're looking for capital to deploy and roll out that proven technology, and you can look good visibility into the cash flows from that technology, our capital would be useful in that case too. So we're going to go as the market evolves to wherever that the proven technology is. And right now, that's utility scale wind and solar and storage.
Okay, so that's really interesting. So you're not going to sort of put your money at risk by going for new unproven technologies. That makes a lot of sense. But in terms of the size of these projects, what are you looking for? Because I guess ultimately this is you're taking an existing mechanism, royalty, and applying it to a niche space like renewables. I'm sure you've got views on how big this space can get, but that proven model needs to rely on revenues coming in. So are you looking for existing revenue generating businesses with, and then you're kind of taking some of that from existing businesses, or are these yet to be built development projects with near-term revenue opportunities?
Yeah, no, it's a great question. It's actually both, and we call it our barbell approach. We're investing at the development stage with good teams with really solid pipelines, and I can talk a little bit about the recent deal with Tri Global, and Enbridge, and we can talk a little bit about that. But that was a developer that we backed at an earlier stage. We gave them the flexible capital they needed to grow their pipeline, and they had a fantastic, successful result. I mean, that was a case where it truly was a win-win-win, where we gave this great team, we identified a great team, they had a great pipeline, they needed a better structured capital that allowed them to keep more of what they were creating. They were having to sell projects and recycle dollars versus it advance their entire portfolio. So our capital came, we were able to structure a partnership with them where we got royalties on the projects in their pipeline. They more than doubled the size of their pipeline from our capital. We invested approximately $46.5 million. And then in a matter of a few years, they were able to attract someone like Enbridge, who came in, paid them a very handsome price. The TGE shareholders did really, really well. Enbridge got a top flight team with a great pipeline, and we're going to get royalties on, between 5.5 and 6 gigawatts of projects. So it was really, and our capital was that enabling capital that allowed that to happen. So that's on the development side at an earlier stage, and we help them through till they become operational. There's also, because of recent changes in market dynamics, an opportunity for us to invest directly in operating projects who want to have more market exposure. Historically, all renewables projects had all of their output locked down under long-term power purchase agreements at a fixed price. Well, prices have been falling for many, many years, along with lower interest rates. In a falling price environment, a fixed price PPA is really attractive. All of a sudden, with inflation and costs moving up and power prices moving up, a fixed price contract isn't as attractive anymore. And these owners are wanting more exposure to underlying market prices. But what that's done, that means that the banks are willing to give them less debt financing because they have more market exposure on the price on the offtake. So then we come in and help them fund that gap now in the capital structure. So it's really both ends, and it's working. And the level of activity on both is very, very high right now.
Right. Okay. So you're the same as every other kind of royalty in the sense that when markets are a little bit tighter, companies tend to have a little less flexibility, and this feels like a much more attractive, or clearly less dilutive form of investment, which is good news for you. For them, they've got to make that. Do you think it wouldn't? It's clearly not the go-to. The go-to for them would be, look, we want to capture all of that value, downstream, as it were, for the life of whatever contracts they have in place. But for you, you've got to make hay while the sun shines, and right now it must be a pretty good market.
Yeah, it's a very strong market. I guess the way to think about it is that we've had massive innovation on the technology front for the last 15, 20 years, where the cost of panels has come down, the efficiency has gone way up, 90+% decreases in the cost of these panels and turbines, yet while at the same time the efficiency's gone up. But there's been zero innovation on the financing front. And if we're ever going to meet all the goals that everybody has, and everyone has very high aspirations about the clean tech revolution and the transition, we're going to need new sources of capital coming to bear. And we're one of those. I'm not saying we're going to be the only one, but I think there's an opportunity for us to grab a very nice piece of the business in the need for new forms of capital to help build out these pipelines and these projects.
Right, and talk to me. Well, then it kind of leads on nicely to the bit I intimated earlier, which is about what's the scale of the opportunity here?
Yeah, it's
because I'm used to dealing with royalty companies based in the mining space, and the mining space is, quite frankly, it's a small space, right? Energy is very topical at the moment. I think most people have got their eye on that, but it's also a very large space. So obviously you're in the renewables component there, but how big is this renewables section going to be as a percentage of the market?
Well, if you look at the broader themes, the way that we're going to reduce our carbon footprint globally is to electrify everything. But that doesn't work. We all drive electric vehicles and we don't have renewable energy to go along with it, and we're burning coal to power our electric vehicles. That doesn't get us where we want to go. So the two really do go hand in hand. And, so the size, it's trillions of dollars over the next coming decades. And I guess if Franco-Nevada is a $20 to $25 billion, the leading, precious metals royalty company in the gold mining sector, if we were able to become the Franco-Nevada of renewable royalties, you're talking to something that's, multiples larger than that is the size of the opportunity. So it's our job to, and we are the leading company right now, so I think it's our job to execute, and that's what we're focused on doing, and really gaining and maintaining that leadership position so that as we become a more accepted and adopted part of the renewable sector, we become kind of like that blue chip name that Franco and Wheaton have in the precious metals markets.
Right. So what have you got to do? Because if I look at Apollo's balance sheet, man, they got deep pockets, right? What have you got to do to impress on them that, one, it's a good, steady flow of opportunities, and that the projects you're picking the right ones, your diligence is working, and that the deals can get bigger. And if they're not interested in that, and I'd be surprised if they weren't, but if they're not, does your deal allow you to basically get outside of both of your current equity investors? Can you go elsewhere?
We could do that, but I don't think that's going to be an issue, and let me tell you why. Because Apollo, in their infrastructure fund, had previous investments in the royalty model in oil and gas. They understand and love the royalty model. The idea that they found a company that's executing on how to apply this model that they already like into a very large opportunity. They are, the pressure's coming the other way, should I say, for us to find more deals and more opportunities. And one of the things I love about our relationship with Altius and Brian Dalton is they've got 25 years of royalty experience. So one of the things Brian impressed on me early on was that the best predictor of the future value of a royalty is the size and length and duration of the resource, right? And so you think in mining, a resource that can grow with time, well, that royalty will have more value. There is no underlying resource which is longer in duration than solar and wind. We're high grading these opportunities. So once we have a royalty on a particular project, it's highly likely that there will be a renewables project there for the foreseeable future, long after you and I are long gone. Because really what we have is a call option on future technology. As the solar panel technology gets better, they're going to replace the current panels with new ones, because it's hard to find a new spot to put a new location versus going back and repowering an existing location. So that embedded optionality, which is really the linchpin of a good royalty investment, which is really powerful in mining where you have a depleting resource. Think about, now take that same concept of this embedded optionality and apply it to a perpetual resource. And that's really the power of what we're doing here.
It's super exciting. The future and technology is a big part of this. But you hit upon something there which kind of intrigued me, which is what about the recycling of the renewables side of things? Because in mining, they've got rehabilitation costs, and they've got to put up bonds and so forth, and that's down to the companies themselves. It's not down to the royalty companies. I mean, you don't have any exposure to any of that, do you? It's just pure. It's the equivalent of a net smelter royalty.
That's what we got. A top line gross revenue royalty. So we get that. Look at the embedded optionality, which is one of the most exciting things I just mentioned. The bluebird value, as I call it. It's if they repower it using new technology. Look, there was an example last year. Brookfield bought a project. Paid full price with the sole intent to repower it. It was only 10 years old, but the economics made sense to put in new turbines. That's going to happen again and again and again. Well, we're high grading these opportunities. We're choosing the best sites first. So when we have royalties on these sites, it only makes sense that they make that investment. We have none of that CapEx exposure. If the license life extensions of these projects goes on, we get that benefit. If merchant prices move up, we get that benefit. So there's all kinds of embedded optionality with none of the associated costs. Same thing as you would have with a mining royalty.
So it's again. It's kind of like mining. Because a lot of the people watching this will understand the kind of mining royalty model, right? So that is on a fixed area within an asset. It may cover the entire asset or part of an asset. Likewise for you, if energy is generated from that particular land bank that you have in your contract, whether they renew it or bring in a different type of energy, you've got a royalty on that space.
Correct. And even if they expand it and they go through the same interconnection node, which would make sense, if they add battery storage to an existing solar project and that increases revenue, we get exposure to that with no incremental cost. Our CFO likes to say, if they start selling hunting licenses on this property, we're going to get our share of the revenue generated from that. So yes, it's a true top line perpetual gross revenue royalty.
I think Mr. Dalton would like the hunting license component. Okay, so that's really interesting, I better understand how that works. Now, talk to me about maybe talk about some of the deals that you've done recently, because the bit I want to get to is the revenue. Because that's the be all and end all, right? So you can talk through some of the deals you've done recently.
If I could just back up 1 second. When we started this, we didn't know whether we were trying to introduce a new source of capital, and were they going to accept and adopt this who are these people coming to me with this new source of capital? I think the fact that we are developers helped us get across the goal line, but we've been able to attract some of the blue chip players in the industry. We've done deals with Tri Global, who was recently acquired by Enbridge. We did royalty financing with Apex Clean Energy, which was acquired by Ares Capital, another large private equity group. We've done deals with Longroad, a recognized leader in the industry. Northleaf Capital, up in your neck of the woods, a very established private equity group. And the counterparties on our royalties, because ultimately, if we give a developer capital, our counterparty isn't that developer, it's who they sell the project to, who the ultimate owner is. Well, in our case, that's been NextEra, Leeward, CIP. It's really, truly has been, the bluest of the blue chip players. So the question of whether the market would accept and adopt this type of financing has been answered. And the answer is a resounding yes, which is really exciting for us, because that was a big unknown. When we started this business, we didn't know whether the market was going to be open to this new form of capital. So, we've done, I think the TGE deal recently, getting acquired by Enbridge, was a great validation of the value of our capital. And, as I mentioned, the other blue chip players I mentioned. So, and we have a strong pipeline of new opportunities. And the recent, the IRA, the Inflation Reduction Act, has only, put gasoline on the fire, and that projects that, may not have been economic otherwise have now jumped and are now economic again, and they need capital as well. So there's it's an exciting time, and the need for flexible partner-like capital is more than ever.
So, well, that's a kind of interesting one. The IRA is this kind of burst of energy into the ecosystem. It's obviously clearly synthetic in a way, but is it, coming back to the diligence thing? because you've got to look long term for all of these things, right? Is it a case of, well, that's just cheap capital, which is what this maybe marginal project needed, or this cash constrained project needed to kind of get it going? But once it's going, the cost of energy that it supplies and the contracts it can achieve into whichever markets it's feeding into, that's the bit we're interested in. What went before, irrelevant to us. That's the way you're looking at it.
It's more of the latter. You're correct. It's more the cash flows from the projects that we're focused on. I would say one thing about the IRA that people don't fully recognize is it didn't deal with a lot of the internal angst in the system having to do with transmission constraints and just the magnitude of the rollout that we're trying to achieve. It didn't do anything to address some of those issues. So they're still going, and any kind of delays in rollout results in the need for additional capital. And the way that we structure our deals is that we are not harmed by delays in the development process. Ours money is accruing. And if it takes a developer a longer time to get an interconnection approval or something, they just owe us more royalties until we hit our threshold return. So
so I missed that. Oh, yeah. Wow.
So
that's huge.
Well, that's because we were developers and we know always take the over, right? These things always take longer than you think they're going to take. And so we said, how can we protect ourselves? So our money is accruing, and if it takes longer, then if we thought it was going to take 3 projects for us to hit our return, just making a number up, and our base return is between 8 and 12%. That's pre-tax unlevered. And if it takes longer so that our money's accruing and they owe us a fourth, well, they just owe us a 4th project. So we're protected from those delays.
Okay, interesting. So, but again, I want to kind of bring back to the mining thing so that's really good in terms of the time frame. From this date to that, well, the start date, and that's great, and it accrues. But with mining, there's a kind of sometimes there's a blue sky component. So I'm trying to think what the equivalent of that is. Is that just a case of the company then scaling up the infrastructure at that site to be able to produce, go from, I don't know, 2 gigawatts to 3 gigawatts? That's your upside. You capture some of that as well.
Once we have a royalty in place, that's our upside. As I mentioned, the Bluebird value, this, adding additional, repowering, expanding, extending, all those, we get that upside. At the earlier stages, our upside is that as they develop more projects, the amount of our collateral actually gets larger, so our risk goes down. And one of the opportunities we found with almost every single of our counterparties is our opportunity to deploy more capital into their existing pipeline because our capital has helped accelerate their growth. So we kind of grow along with them, and then we get more projects. So that's been, to give you an example, we started with Tri Global with $7.5 million investment, and before Enbridge acquired them, we had deployed $46.5 million. So we grew along with them, and their pipeline went from a little over a gigawatt to almost 6 gigawatts during that time. So, more money deployed, better pipeline, more projects. So it really is a win-win.
Okay, and back to the revenue component. What's the guidance you're issuing?
Yeah, so we just yesterday actually we had earlier in the year we looked at our existing pipeline of projects and what's operating today. We have 6 operating royalties. We have 3 in construction, and we have 22, I think it is, in our development pipeline. But based on what we knew was operating this year, we issued initial guidance of $4.5 to $5.5 million. That's U.S. for Great Bay, for 100% portion. And we just, based upon this summer period where prices were much higher because of, in large part because of heat wave through Texas, we were able to increase that guidance to $6.5 to $7 million. So a significant increase in our guidance. And we also are well situated to continue to grow that revenue stream. If we didn't make a single other investment right now, based on what's already in our pipeline, we're going to see exponential growth in our revenue over the coming years. We're going to make additional investments because I can see what's in our pipeline, but we are very well situated for continued strong revenue growth.
How does a humble scribe like myself, who might want to kind of model this, get the information to be able to work out what the next 3 years could look like?
Yeah,
in terms of
there's some we haven't provided 3-year guidance, but there are some. I know some of the analysts out there at the investment banks have done their own modeling and have their own forecasts, but we haven't provided that guidance to date. we've just done the 1 year. We were just getting going. As we get better visibility, it wasn't clear to us. We have 3 in development. Wasn't clear, that are actually in construction, not development. 3 new projects that will be coming online. Knowing exactly when those things are going to turn on, and I don't want to. We definitely want to be in a case where we underpromise and overdeliver. And I would just say when we went public last year in March, we said it was going to take us 2 years to be able to deploy the capital. I think we've deployed it already in deals better than what we thought we could find, and we have a great pipeline of future deals. So if anything, we've over-delivered on what we told the market at the time we went public.
Right. And so do you think you're getting fair reflection of that at the moment, or was it a case of you're just starting to get known? I mean, what's the market cap today?
I think there's 2 things. One is renewable royalties is a new thing. I think we don't believe there's a better way to invest in renewables than through the royalty model, for the same reason that if you want gold exposure, you might look at a gold mining royalty company, or whatever other base metals. You might look at Altius for the exposure. We think it's the best way to get exposure to renewables, but that story's just getting out. And then also our stock has taken a bit of a hit with the recent market downturn along with everybody else.
Perfect time to buy. Massive discount. Is that what we're going to say?
I don't. Can I say that? I'm not sure.
Oh yeah. Oh yeah. Hey, well, look, Frank, that's a really lovely introduction to the company. Obviously, love the renewable space, love the royalties space. You kind of brought the 2 together, which is good news. We will definitely try and come back and speak to you again, see how things are coming along with your projects, etc. But I appreciate your time today. Stay in touch, okay?
Thank you. Follow our progress. We're going to have lots of exciting news going forward.